Be your own bank. Stop moving your money the way the wealthy do. Infinite banking trend has been hopped on and hopped off by so many different quote unquote financial influencers. Quite frankly, I felt it was time to pretty much address what I felt were the undisputable facts, positives, and negatives of this idea and trend, and specifically talk about those that actually promoted heavily this idea, Mr. Chris Naugle and David Burr. Being an entrepreneur and wanting to learn from some of the great entrepreneurs out there at the moment of our time, I listen to Brad Lee TV. Not only is he a pretty smart guy himself, but he has a lot of smart people on, and they've all done what I want to do and been where I want to go. One of his guests recently was a Mr. David Burr. Now, David Burr is pretty well known on Instagram, TikTok, pretty much all your social media channels, and he's most widely popular for heavily promoting this idea of infinite banking. Now, he learned this idea from Chris Naugle. Chris Naugle is like this ex-professional snowboarder turned like money mogul. He's pretty heavy in the financial coaching world on social media, and essentially he got that idea from a author who wrote a book called Infinite Banking, met with David Burr, who picked up on it. Essentially the two teamed up to heavily promote this idea. So he had a few explanations of infinite banking on the episode that I kind of disagreed with, and I pretty much have disagreed with many of the explanations on social media of infinite banking in general. I feel like it often leaves out a lot of pertinent facts, and if not really properly advised, can be kind of misleading. I urge everyone to go and watch the episode, especially if you have any interest in infinite banking. First and foremost, you need to go and speak with a financial advisor or a licensed life insurance agent. But this episode would be a great place to start. He does explain the general concept very well, but there are some parts to it, again, that I disagree with. The first part is Brad kind of offers this example of if he was to want to buy a $20,000 car, he would put $100K in the bank rather than taking $20,000 and financing it to purchase the car, takes it from his own bank account and then repays his money as if he had financed it, but instead he's just repaying his own bank account. So David Burr then steps in and says, yes, very similar concept, except we're using a life insurance policy instead of a bank account. This is where I disagree. He adds one more thing, and he says we do this because if we were to take that money out of the bank account, you would no longer receive that very small interest rate that they offer, 0.5, 0.6% a year. In comparison to if you take that money out of a life insurance policy, a specially designed whole life insurance policy as he describes it, you'll still receive guaranteed 3.25% in interest. So let's break down this idea of a first and foremost specially designed life insurance policy. What he is talking about here is not actually a whole life policy at all. Now he and Chris Naugle have this habit of calling it a whole life policy, but it's not at all. It's actually what's called a universal life plan. And judging by the way they talk about a guaranteed 3.25% interest rate, it must be a guaranteed universal life plan, meaning the interest that they are willing to credit your cash value is guaranteed annually despite what the market does. These policies also typically guarantee the death benefit for a set number of years. They aren't actually whole life policies at all. They're guaranteed or possibly indexed universal life plans. Intricately involved in a universal life plan is the idea of an adjustable premium and an adjustable life. In fact, that term is typically used in the title of the plan itself. As the name implies, you can adjust the premium that you pay in the policy and adjust the death benefit over time throughout the duration of the policy's life. Typically guaranteed the right to decrease the death benefit. Increases of the death benefit will be subject to underwriting. Now, when you take money as a loan out of a policy like a universal life, even if it's a guaranteed universal life, it does not really matter what type of life insurance plan it is. Loaning money out, the act of borrowing against your own cash value. So you're taking money out of the cash that you've built plus the interest that you've built with it and compounded with it, with the promise to repay that money and the promise to pay an interest on the outstanding balance of the money paid out until it is paid back. And the reason why I disagree is very much like a bank account. When this money is to come out of the policy, that cash surrender value, that policy value is deducted in accordance with the amount that you loaned out. So just like a bank account would be deducted by the amount you withdrew, life insurance policies, cash surrender value or just cash value, policy value, would be deducted by the amount that you loaned out. You would not continue to accrue interest on the amount that you loaned out. It does not stay in there. And then the death benefit is used as collateral against that. So in the case that the borrower were to pass away, the company would remove the portion owed from the death benefit paid out. This is often confused and conflated, and I don't think David Burr does this, but I've seen this several times on social media. This is often confused with the idea that you are loaning money out against the death benefit, which is false. You are not loaning money out against the death benefit. They are not deducting the death benefit to send you that money. They are deducting your cash value. The death benefit only gets deducted if that money does not get repaid and a death to the insured occurs. So the death benefit is simply being used as collateral against the loan. So $30,000 out of a bank account reduces your account balance by $30,000. $30,000 loaned out of a life insurance policy reduces the cash value by $30,000, and you are only going to receive that interest rate, whether it's guaranteed 3.25%, as he explains in the episode, or it's indexed or variable, which could be in far excess of that. No matter what the credited amount is in interest, it's only going to be based off of the current value of the cash that's in the policy left. It's not going to include any money that's been loaned out. So the premise that you are still getting interest on the amount of money that you took out is false. Think about that for a second. I mean, one of the things that he goes into the episode explaining is how a bank account will arbitrage your money, will take your money, pay you a very small interest rate on holding your money for you, but for the guarantee of them holding it, and then take that money and invest it, take it and move it around and try to make far in excess of what they promised you in interest, right? And that's how they make their money, right? Through loaning operations and investments. The insurance company is doing the exact same thing, right? They are taking the money that you are accruing in cash value. They're not holding 100% of that money, right? That 100% of that money is insured and guaranteed in case you were to draw upon it. But they are not holding that money. They are also looking to invest that money and make a larger return on that money. That is a part of how they make their money. That is a part of their business. There's also arbitrage in the insurance and the life insurance business. They are taking the cash that you are paying them now, the little bit of cash that you are paying them now, and trying to make as much money off of that cash as they can before they have to pay out a large life insurance death benefit. So therefore, it would make no sense that they would be willing to lend out the cash value to you while still maintaining your cash value account as if they never lent any money out and crediting you interest as a portion of that account value. It would obviously be a failing venture. Now, as he does correctly state, obviously, interest on a guaranteed universal life index, or if it's in the right year, variable life insurance, universal life insurance policies can be in great excess of anything a bank is going to give you. And so therefore, any money that you have in that account will probably compound a lot quicker and a lot higher than anything that would have been in a bank. And then it is probably a very smart way in that method of accruing more interest on money that would have been in the bank. Leads me to kind of the second piece that I disagree with, and it's the fact that we're comparing a life insurance policy to a bank account at all. Very much so unlike a bank account, and to Susie Orman and Dave Ramsey's point of view on the matter, life insurance always costs you something because of the promise of the large death benefit that you're being covered for. So every dollar that you put into a life insurance policy is going to be deducted by the amount that it costs you to be covered, also known as a cost of insurance. Obviously, a bank account and an investment account do not have those. So every dollar that you put into any of those accounts will reflect immediately. And that way, it's not really comparable, right? One, you put in $1, you might have your value reflect 70 cents. The other, you put in $1, you have $1. So I try to be pretty fair. I think David Burr and Chris Noggle are promoting a very healthy idea that people should be more accountable for how much money they are spending and not paying themselves. And that if people really wanted a shortcut Two, being able to finance their own operations and not have to go out and use credit cards and take loans. Using life insurance as a way is actually a really great method. Going back to the bank accounts and investment accounts, life insurance has that one large advantage of being tax-free. Also, the very death benefit that you pay for, of course, is a large advantage in itself, and that if you don't happen to make it to the point where you see all these cash benefits, at least your family will get more than the actual value that you put in. My only concern about David Burr, and I haven't looked too much into Chris Naugle, here's my only concern. Throughout the episode, I heard a lot about his past. I heard a lot about what kind of got him into this industry and how he hooked up with Chris Naugle and all the books that he read to kind of put him in this mindset, and how he then eventually actually took out a policy on his own and practiced what he preached. And I think that's awesome. My concern lies in the fact that this is an industry heavily regulated. We all have to be professionally licensed and keep up with the continuing education requirements. Roughly, I think 40 a year, maybe 80 every 2 years, depending on what state you're in. And there's, of course, insurance. There's liability insurance that we have to pay for and maintain. All the things that would come with being in a professionally licensed career. And hearing about his past and kind of what got him to where he's at now, I didn't hear any part about him actually being licensed. I didn't hear anything in his story about him actually studying, going out and getting his license. I would have thought that that would have been kind of a key point, considering he was pretty clear that him and Chris Naugle have gone into a business venture together where he is effectively marketing this idea on social media, as we have all seen, and then passing the names on to Chris Naugle, who then passes them on to whoever who ends up writing them these infinite banking policies, these quote unquote self-banking wealth moves. A little insight into our industry: you cannot receive any funds in any way directly related to the sale of life or health insurance policies without yourself being licensed. And it's like that in pretty much every professionally designated, licensed, regulated industry. A lawyer can't take lawyer fees without having first passed the bar. Now, they could be licensed. They both could be on the up and up, and I'm not suggesting they aren't. I have no evidence to show that they aren't. I just haven't heard them actually say that. It's not mentioned in any of their profiles anywhere. All they mention about is investing, promoting this millionaire mindset. So I would just caution before anybody actually go into business with them trying to achieve this infinite banking concept, they at least confirm that these two are professionally licensed and able to actually sell the types of policies that they are promising. That way you can actually hold somebody legally accountable if things do not work out in the manner in which you were marketed. And again, I have no evidence to think that they wouldn't, other than some of the what I feel are misrepresentations about how this kind of plays out when you start loaning monies out of policies. Just a word to the wise: anytime you're working with a financial advisor or anybody working with your money, right, a licensed life insurance agent, you should always check to make sure that they are professionally designated and licensed. Now, it's funny because listening to many of the other social media types that have kind of hopped on this bandwagon that they have started, their message has been taken and deviated to a pretty decent degree. So I don't want to blame them for some of the ways in which things have really been misrepresented. I'm only going off of this episode on this podcast and using David Burr's own words. Now, the concepts that I think he's alluding to, and maybe just isn't accurately describing, maybe he just doesn't want to get into the weeds about it, are solid. You absolutely can overfund, and probably should overfund one if you're going to take out a universal life policy, and use that overfunding as a means to accrue excess cash value that you can then use to either finance your own retirement or your own loan transactions or really whatever. The method is solid, especially when we talk about arbitraging one interest rate for the other. Effectively, what that means is that the money left in the policy, right, the money that's left over after you've taken out some portion of that cash value, will continue to accrue interest. And if the balance of that money is large enough, oftentimes the interest that it will accrue will be in excess of the interest that will be charged on the outstanding loan balance, meaning the interest accruing on the current cash value after the loan transaction is going to pay for the loan interest due on that transaction. So effectively, a free loan against yourself typically takes at least, I always advise my clients 20 to 30 years of leaving that money in there, paying your premiums, letting that money compound. So I want to make sure you've cleared any cash surrender charges so that withdrawing that money instead of loaning it is an option. And what withdrawing does is actually allow you to take that money out with just a permanent deduction in death benefit, no loan interest rate due. I think one of the things often lost in some of these other posts about infinite banking is this idea that this can be done almost immediately. Can't. Not 3 to 5 years, not 6 to 8 years. I don't care how much money you're putting into it. It's not efficient doing it immediately. It's only when you've had real time for that cash to accrue and compound that it becomes efficient to actually remove that money. I hope if you were out there maybe considering taking out one of these policies, this helps you. Of course, I'm open to any questions